Sorry about that. Just doing some more testing here. I'm actually testing the lag between what I see on YouTube and what my live stream software is showing me. So there does seem to be a lag. I was curious about that. Sorry about that. See? Just doing some more testing here. There's a little bit, a 20-second lag going on there. I'm actually testing the lag. Yes, so I will close that down. Anyway, here I am talking to myself again. Yeah, so I'm going to give everybody a few minutes to pour in here. I'm going to address a few of the things that came up in the last stream, and that was one of them. Of course, everybody was complaining that there was a lag, and I just did a little test there, and yes, there does seem to be at least a 20-second lag. So that's going to be, it's going to make things difficult for answering some of the comments that pop up, but we'll just give everybody a few minutes to come in. I did email out to the VTS community, so there might be a few of those people coming in as well. I realize Sunday is not the most convenient time for people. I was going to do it Saturday, but yeah, didn't have time yesterday, so. Yeah. Oh, my sister's in here. Thanks, Lisa, for checking out the stream. Cool. Vanessa's in here, of course. She's my #1 fan. I see your little comments there. Okay. Yeah, my live stream software has just had a little pop-up that said it has lowered the bit rate or something because the internet connection is bad. So that could be explaining some of the lag that we're experiencing, especially with the comment section. And I'm in Vancouver. There's no reason the internet wouldn't be good. I always feel like it's fine. But apparently for the live stream software, it is telling me that it's not quite set up right. So that could be just troubleshooting in the back end. I'll try to figure that out before the next stream. So, Lisa, are you related? Yes, that is my sister. Same last name. That's a last name you won't see very often. So if you see any Ossichoffs out there, pretty good chance they're related to us, especially in Canada. Yeah, cloudy day here in Vancouver, unfortunately. The last stream, it was nice and sunny. It's pretty hit and miss this time of year, but the temperature's fine. It's about 7 degrees. I'll be going out running right after the stream, just like last time. But yeah, I don't mind the gloomy days. I actually kind of like it. I'm kind of a, we get sun in the summertime. I kind of like having seasons. So seeing some rain, some gloom, it's totally fine with me. So 59 people in the stream, which that's pretty cool. I'm just going to wait a couple more minutes. Maybe what I can do while I'm waiting is I can just go through my little checklist here of things that came up in the live stream. So I'll just go through the checklist. Thank you, everybody, for all the feedback. It really, really does help me streamline this. I don't want to be one of those people that takes 50 or 60 episodes before it's even watchable. So having that feedback, and feel free to give constructive criticism, but it really does help me a lot. So a few of the things that came up. First of all, that popping sound whenever somebody was making a comment. I was so nervous last time, and to be honest, I am right now. But that little pop sound that comes up, I have addressed that. I've figured out a way to turn it off, so you guys aren't going to be subjected to that every single time. I think there was 1,200 comments in the last stream, so having that little pop every single time, you guys have a lot of patience for sitting through that. Sorry about that. I didn't even know it was going on. The second thing that came up, and this is just going to be something that takes practice, but I have lowered my camera down a little bit, so I'm going to be practicing staring directly into the lens. But the issue that is coming up is that I've been in Vancouver for about 4 months now, and it's just about time to head out to somewhere else, so I will be moving soon. and I just don't have all the equipment I need. So the camera is actually pretty far away. What I need to do is get a new camera, but the one that I want, for any of you camera geeks out there, the Sony a7S III, it's on back order here in Vancouver, and I just can't get one. So if I do get that and I get the 16mm lens, then the camera will be basically within an arm's reach, and I will be able to put it just over top of my laptop. And it should appear that I'm talking to you rather than you guys staring at the top of my head. So I don't feel like buying any new equipment in the next week because I am moving soon, but I'll fix that soon. The third thing, which I just briefly mentioned, but very important for you guys in the comment section, you might be frustrated by it, but when I watched the rebroadcast, I noticed that there were many more comments showing up on the YouTube side than my software is showing me on my end. When I was doing that live stream, and it was, 3 hours and 20 minutes long, I actually wasn't seeing that many comments. So I certainly wasn't, it may have appeared that I was not answering some of them. I actually didn't see that many. So we'll see what's going on today. Just to give you an idea, I can see essentially, just quick eyeballing it, I can see about 15 comments. So you guys on the YouTube side of the software, you might be able to see that there's been many more than that. But for whatever reason, it's just not really showing me all the comments. So I might have to actually try a new software. Just give it a shot, see if it's Ecamm. The one I'm using is called Ecamm. But we'll see. Bear with me. These are all technical things that I will be working through. The fourth thing, as I said, the last stream was 3.5 hours long. I didn't intend to go that long, and to be honest, it didn't feel like it. I remember there was a point about 30 minutes in where I looked at it. I couldn't believe it. I thought it was 3 minutes long. I thought we had just started recording. So apparently time really does fly during these live streams. So 3 hours, it felt like 45 minutes to me. But I'm going to try to keep them to 1 hour, and I'm going to keep an eye on the clock. And at about 1 hour, I'm going to, cut it off. And I feel like if we do more streams that are shorter, it's going to open it up for more people to sit through it. Who has 3 hours? I'm flattered, humbled by all of you who did sit through 3 hours. Looking at the analytics, there was actually quite a few of you, so thanks for that. But definitely, I'm going to reduce these to about 1 hour. The other thing is, and this is going to be important to the VTS community, is I will try to find a way to divide the live streams. So I do one publicly, like you're seeing now. Anybody can join. Just go to the YouTube channel, click on the link, and you can start watching. The other thing I do have to figure out is how to do a private live stream for just the VTS community. And those would, of course, be very specific questions to just our trading and our portfolios. The YouTube community is free to watch all the live streams, but they won't really understand those questions, so I should probably divide those communities and just make it so I can figure out a way to do that. Not so easy. It's on YouTube, certainly that's not an easy task. I'll try to figure it out. Excuse me. And the last thing, as I check to see how many people are in here, that's about right. So the last thing that I will try to do is more structure, right? The last time I just basically came on, did a little sound check. I was done in 3 minutes, and then we just answered questions for 3 hours. What I'm trying to do is have a little bit more structure. So I'm going to present something, maybe something very quick and simple, a couple of charts. Hopefully you find it interesting, but of course there's going to be many people who maybe already know what I'm presenting. There's really nothing I can do about that, but I'm going to have about a 15, 20-minute little short presentation, and then we'll just open it up to questions. And so as I'm seeing people join, thank you everybody for coming. Somebody says this is the 24th comment they see. That's actually not that far off. I'm seeing about 15, so we'll see. The only way I can fix these problems is to do the live stream and then watch the rebroadcast afterwards, and I can try to fix things as I go. I was just watching some very old Joe Rogan podcast just to get an idea for a few things, and it wasn't always so polished either, so maybe there's still hope for me. But let's start the presentation. So the first thing, I'm going to try my picture-in-picture. Some people said that it was a little bit annoying seeing me down here. So I've got two choices. I can either just remove it completely and just speak, but let's go ahead and get into, don't need that anymore. Let's go ahead and get into what I wanted to talk about today. So I thought we would start with something that's a very simple topic. We would basically just review the current volatility landscape, because these volatility products, there was a time, certainly 3-4 years ago, where there was very many of them, and they seem to be launching with new ones and new methodologies. There was quite a large landscape. But recently, of course, if you've been following this space, you know that we've lost a couple of them. And we've also, some of them have disappeared and nobody noticed, but some of them that we've lost are actually some of the more popular ones. So I just wanted to do a quick review of where we're at in the volatility landscape today. And then after I go through this, we'll go ahead and open it up to general questions, just like last time. So the first thing we need to know for all volatility products is it is based on an underlying index. This is something that a lot of people don't fully understand. They think that the VXX, the TVIX, the UVXY, these are all independently traded, essentially stocks, right? And based on the volume, that the prices will move around like that. And what's actually happening, the truth is, there is an underlying index, an underlying methodology. Just pull that up here. This is the SPVIX STR index. And all of the volatility ETPs that you see out there, the ones that you trade, VXX, TVIX, all of those things, well, TVIX is terminated. We'll get into that in a second. But they all trade on this methodology. So it is essentially, this SPVIX STR index utilizes prices of the near 2-month VIX futures contracts to replicate a position that rolls the nearest month VIX futures to the next month on a daily basis in equal fractional amounts. So kind of wordy there. This results in a constant 1-month rolling long position in first and second month VIX futures contracts. So we can pull up our old VIX Central here. Everybody knows this website. And we can essentially see the term structure. What that said is essentially we are looking at only those front 2-month contracts. So this is the January contract expiring in 2 days, February, March, April, May, all the way out. The only ones that affect us and the only ones we have to look at are these front 2 contracts. And what that whole wordy thing said, essentially, is that it is using a methodology to combine the first 2 contracts into what's called a rolling 30-day constant maturity future. Okay, again, if you want a more detailed explanation on the YouTube channel, I very recently made a video. It's this one here. Don't buy VXX, roll yield crushes it lower. I realize people don't want to get too into the details here. This stuff is very boring, but I tried to make one video 10 minutes long. If you watch that video, hopefully you don't ever have to talk about this stuff and listen to this stuff again. But this constant maturity future is actually quite important for our trading. So if we go back to that SPVIX STR index, this is what everything is based on. So if you've got the VXX, it is a 1x product of this. It is exactly mirroring that. This is the SPVIX STR index since VIX futures launched in 2004. And over here, this is just on a log scale, so you can see it more consistently over time. This red line is the VXX. You can see, aside from a different starting point, it is essentially the exact same methodology. So the VXX is not only the first volatility product that we have, but you could consider it the baseline product. It, of course, still exists. It's highly traded. It's got a very liquid options market. So you've got the VXX, which is, in our little landscape we're building here, the VXX is number 1. So you can see it launched on January 29th, 2009. In fact, I'm just going to scroll over here. We're going to go to the log scale because you can see more consistently over time. So it launched in 2009, and right now it's gone from 102,000 to 17 bucks. So it's basically, as everybody knows, these products have a tendency to trend towards zero. But the thing that I wanted to address quickly here, let me just see how many people are watching. Okay. Good. So hopefully I didn't start that too soon. Excuse me. But the thing that's important to remember is that the products aren't necessarily designed to go to zero. That's just a function of how they work, right? It's probably a bad idea to enter this volatility space if you think that these products are manipulated and mismanaged and created poorly to the point where they are designed to go to zero. They're not actually designed to go to zero. These are basically insurance products. If you were to plot a 30-day constantly rolling VIX or S&P 500 put option as a hedge, it would look very similar to this. And that is by very design. Of course, go to the full screen here. In the way this works is the VXX isn't meant to be sort of a tradable instrument that everybody's using for speculation. It is mostly used, certainly by institutions out there. It's being used as an insurance product, as a hedge for a long portfolio. So of course, anytime you are long volatility, it has to decay. If there was a situation where the VXX and the UVXY and all of them, if they didn't decay, then everybody would buy them at all times. Everybody's portfolio would be fully hedged, and the markets wouldn't exist as we know them. That's not how it works. Insurance products decay over time. That is what you are paying to have your portfolio hedged. So that's the first thing, just simple mindset. These are not designed to go to zero. That is just a function of how they are built. So you can see the VXX here since March 2004. This is simulating the values because it actually launched live right here, right at the peak right there in January 2009. But because it's entirely based on VIX futures, we can simulate all the way back to the launch of VIX futures in 2004. And you can see right here, the last financial crisis, of course, it didn't start in October 2008. That's just when it started accelerating and crashing. The real financial decline started in February 2007. You can see right here, February 2007, VXX reached a low point, an all-time low, and it actually, on a buy and hold basis, didn't actually break down below that low until later in 2010. So we're talking about 3.5 years. The VXX didn't decay on a buy and hold basis. And there was actually obviously some opportunities to make some money. So the product is not designed to go down. It is just, if volatility is low and the markets are bleeding upwards and everything is fairly stable, then naturally all insurance products, long volatility, put options on the S&P, VIX futures, VIX options, VIX calls, all of these things will bleed. That's the price you pay to get into the market. You were trying to hedge a portfolio. So all of us out there, that we jump into these markets to try to speculate and actually make some money, that's just a byproduct of what it is. But it's important to have the right mindset with these things right from the start, that this is not some type of, design where they're trying to transfer wealth from us poor retail traders to the hands of the issuing banks. It's not exactly like that. These are not manipulated. They function exactly as they're supposed to. And we can just use them and find opportunities to make money off them. So that's the VXX. That's the first thing in our volatility landscape. That's the one you want to focus on. It has great volume. It's got a very liquid options market. The VXX will probably be here for the duration because it is just a 1x leveraged. It tracks exactly the SPVX STR. So it's probably going to survive pretty much anything the markets throw at it. Moving down to a little bit more exciting stuff, we've got the UVXY. Now, the UVXY is a 1.5x volatility ETP. So it is long, same thing, SPVX STR index. Again, I'll watch the rebroadcast later to see if that makes you dizzy when I'm scrolling around and how to get the speed just right so everybody can follow it. Bear with me. Sorry about that. But the UVXY is exactly the same methodology as the SPVX STR index, completely the same. It's using just the front 2-month VIX futures. It is rolling those contracts on a constant 30-day. The only difference is it is a 1.5x leverage factor. So, of course, it decays even faster. Not by design. Remember, it's not supposed to decay. It's just an insurance product. Of course, it's going to go down. Now, worth noting, if you're new to the market, you may not know this, but UVXY used to be a 2x leverage factor. But after the Volpocalypse event in February 2018, they deleveraged the UVXY from 2x, which would max the old TVIX, down to 1.5x. That happened on, I believe, February 27th. So now it is a 1.5x leverage factor. You can see it here on a log chart. This is going back to its launch on October 3rd, 2011. So it launched, a couple years after the VXX. They obviously liked what they had with the VXX. It was bringing in a lot of volume. So they naturally, let's go for some leverage, right? This is the financial industry. Of course, that was the next logical step, is to start really cranking these things up. So it launched as a 2x leverage factor product in October 3rd, 2011. Now, all of these splits here, I should explain what you're seeing there. Because this thing so violently goes down over time, they do have to do what's called reverse splits. So anytime the price gets down lower, say $8, $9, somewhere in that range, they have to do a reverse split and bring the price back up. Otherwise, it would just trend towards 0.0001 penny, and it's an untradeable product at that point. So they do these reverse splits quite regularly. And what a reverse split is, essentially, they just increase the price, they reduce the share count, and there you go. You've got a product that should have been at zero by now. Now it actually has a price that is tradable. And there's been 9 along the way, quite big ones. So you can see it launched. This is the live launch, but I'm using 1.5 times simulated all the way backwards. So this chart is not showing 2 times up until the 27th of February and then onward. It's 1.5 times all the way backwards. And you can see it launched at $1.7 million, and now it's at 1090. So again, down 99.99%. It is going to zero. It will continue going to zero long term. Of course, it also has periods where it does reasonably well on the long side. But yes, insurance does decay. It has to. I mean, you can't insure your house for free. You have to pay that upfront premium, and you are expected to lose that premium. The reason that we pay it, the reason we buy fire insurance, is because perhaps that one time when you really did need it, it's actually going to pay off. But all the other times, you just send your check in every month, you just lose your money, and that's what these products essentially are. They are fire insurance for a portfolio. And so this is simulated back to 2004. And again, you can see while it did launch at 641 million down to 1090, it actually also had some periods where it did reasonably well. On a buy and hold basis, there's 3 years there. You can see recently we had that spike. This recent spike is even more pronounced in the VXX. You can see this is now the 1 times product. The all-time low was right before Volmageddon. And on a buy and hold basis, 2.5 years later, it was still at the same price. So the idea that VXX just always goes down and you can just buy and hold a short position on it, well, you can just look at these charts. That is clearly not the case. And this is a very new product, right? There are periods in the past where we could point to that this would not be something you would want to just blindly be shorting. That's just what, sells on Twitter. That's just what those people who don't manage businesses, they don't have any trade history, they're new to the market. That's just what they say on Twitter to get likes and retweets and all that stuff. But people who understand volatility, not only during the life cycle of these products, but also going backwards further, we could certainly point to some periods that these products would not be things you would want to just blindly short. For example, from 1996 to 2000, the VIX index itself was in the low to mid 20s. And of course, what we know about the market back then, it was climbing higher right up until the dot-com crash. So you would have been watching a market, the S&P 500, going up 20 to 30% a year for 4 years straight. And these products may not have actually declined very much. I mean, it would have been very frustrating for people to be trading the VXX thinking, somebody told me on Twitter this is supposed to decay. I'm just supposed to short this thing. I'm supposed to sell naked calls on this. And you're watching the stock market storm higher, and all of a sudden your VXX product isn't really doing what you thought it was supposed to do. So you have to have the right mindset going in of what this actually is and how it's going to behave in different volatility environments, because they are not all the same. Obviously, this thing decayed very hard for the 9 or 10 years after the financial crisis. But we could see periods of 3 to 4 years where that may not be the case. So definitely study up, figure out what these things are. Of course, the key component is this index, the SPVIX STR index, and understanding the VIX futures, the fact that it is these two futures that you're looking at. That's what you need to do. You have to trade products that you understand. And they're not so easy. These aren't stocks. There's a lot of moving parts behind these. So anyway, that's the UVXY. That is the second product on our volatility landscape now. And what I would say about the UVXY, and people who follow my work, you know this. Just check if everything's okay on the front end here. Oh, no. Okay, give me a second here. Ha! Technical difficulties. Massive technical failure. Wow. You were looking at me the whole time. Sorry, guys. Rookie mistake. You were supposed to be looking at the charts, of course. Let me just see what I just said. All of that stuff I just said. Okay. Huge apologies, gang. I'm going to try to remember what I just said and just recap the most basic part so you can actually match a picture to that long rant you were listening to staring at the top of my head. So the first thing, I'm showing a log chart of the VXX, and I mentioned, going back to 2004, this is the bottom in February 2007, and this is where it finally broke to new all-time lows in basically October 2010. So longer than 3.5 years, the buy and hold on the VXX wasn't the disastrous thing that everybody has been led to believe. And then this is the UVXY. Sorry, you're going to just have to match these pictures with all that stuff I was just saying. Sorry about that. But same thing here. You got the UVXY all-time low. Took quite a while during the financial crisis. Many opportunities to work both sides of this ETF. And same thing over here. Recently, the whole just blindly short it, cover your eyes and sell naked calls, that's just Twitter stuff. Don't focus on that. So let me see if I can get a little bit better at this stuff. So that's our landscape so far. We've got the VXX, which is the original product, 1x leverage factor. That's the one that you want to default to. And anytime that you're doing your trades, I would suggest you start there. And the only time you're going to deviate from the VXX is if you had some strategy that you really did require some custom design, which I'm going to get into now. So the UVXY was one of them. If for some reason you did need the larger leverage factor, which I would say you definitely don't, but if you did, sure, you can include the UVXY on your landscape there. Just to give you an example, the only time I really use the UVXY is if I'm doing defined risk spreads, like if I'm doing a long put vertical spread, expecting the price to go down, go into that range, or selling a short call vertical. Same thing. It's an identical trade. I have a video on YouTube showing that long put vertical, short call vertical, it's mathematically identical. Anytime you're doing one of those two, because it's a defined risk spread, maybe in that situation you want something that decays faster. And since UVXY does require more margin in your account, it's not an efficient product to trade. The VXX requires half the margin, so it's definitely more efficient. But on a defined risk spread, you are just paying the upfront premium, so it doesn't matter. And so that could be a situation to use the UVXY. But anybody who follows my work, you know that I mainly trade the VXX anytime I'm using one of these products. So now, let's remember to click the screen share. Mental note, always click screen share before you show your spreadsheet. Okay, and I'll watch the rebroadcast later, but which one do people prefer? Do you prefer to see a tiny little me down there, or do you prefer to just go the full screen? I'm going to go ahead with this one. So now we are moving on to, oh, here it is, TVIX. Now, TVIX was terminated, and TVIX, it launched on November 29th, 2010. Again, I'm going to look at a log chart. It's exactly the same, just logarithmic charts allow you to see the relative change rather than the actual absolute price change. It looks like a complete nightmare on a normal, arithmetic chart. So you want to look at a logarithmic chart anytime you're seeing something that has changed price dramatically. And of course, that's the textbook definition of TVIX is dramatic price changes. So here we go on a log scale. Again, we need to reverse split this thing along the way because it would be at 0.00 with many zeros, 1 pennies at this point. This product on the live launch, November 29th, 2010, from $2.5 billion down to $112 when it was finally delisted on July 2nd. Oh, computer told me my screen watch time is down this week. Thanks for the live reminder. Okay, so then we can also simulate this back to 2004. Just like with all the other products, this is only using the front 2 months of the VIX futures, only these two. It's using the methodology of the SPVIX STR index as a constant 1 month maturity. So that means that regardless of the live launch date, which in this case was November 29th, 2010, doesn't matter to us because the VIX futures launched on March 26th, 2004, and we can simulate the prices going back to then. This is another thing that I'm just going to do a little side tangent here, go full screen. I see a lot of people on Twitter taking their data and their statistics, sometimes from the launch date of the product, right? So they will say the product has done X number of spikes, or it has declined X value per week, or something like that since the official launch date of the product. Now, hopefully you can all see the glaring problem with this is that the launch date of the product is a completely arbitrary number. It is just when that issuing bank finally got their regulations together, they jumped through all the regulatory hoops, and they finally got the product launched. But that has nothing to do with the VIX futures. The VIX futures have existed consistently the entire time. So do we care when, iPath or ProShares actually got their stuff together and launched the product? We don't. That's just an arbitrary date. So anytime you can, if at all possible, you should always want to be going to the March 26, 2004, the launch of the VIX futures. You don't want your data because remember, these products launched here. You don't want your data to be representing the very best 9 or 10-year bull market period only. You want your data to represent as many different market environments as possible. So yes, very conveniently, we can skip the financial crisis if we want and go from the live launch date, but that doesn't help us get the most accurate data. So whenever you see those types of things, you got to remember that that data could be wildly skewed and completely meaningless with our trading. So that was just a little side rant, but here we go with the TVIX, 2 times leverage factor from 19 trillion to $112 at launch. Obviously a very big number, going down to essentially 0. So I see no reason to include a 2 times leverage factor product in our volatility landscape. A, because there aren't any left, but there is actually a filing for one. So these banks, TVIX was a wildly traded product, huge volume. I guess people liked it. It's not out of the question that we will see another one. But when another one launches, I would not include it on your radar of things that you're going to be looking to trade. It's too risky. It's too leveraged. There's really no point to use it. You can do everything that you need to do in your account with just the 1 times VXX. So it's... Oh, screen share. It's there. It might relaunch. There might be a replacement for this thing, but I would strongly encourage everybody to ignore it if that day does actually come. This is the old XIV. Just in the interest of saving time, the ZIV. I'm going to go through these extremely quickly because it's already been quite a while, and I wanted to get to some questions. So the ZIV, the only difference here was that the ZIV is doing the exact same methodology, except it's using 4, 5, 6, and 7. So it's using these middle contracts instead of the front 2 contracts. And based on the shape of the VIX futures term structure, we know that these ones move a lot faster than the middle section of the term structure, right? The gap between M4 and M7 on average long term isn't nearly as fast moving as the gap between M1 and M2. So what you've got with the ZIV, which was my favorite financial product in the world, I was so disappointed when it was delisted. What you've got here is a slower moving product. And this is one that I do hope somebody out there, some bank, actually does get one listed and trading again, because this was a fantastic product. And I hope we get another one. But just to give you the basic statistics before we move on, because it is gone now. You can see this one, it launched at 1598, or it didn't launch. That's the simulated product back to 2004. and it made its way up to 28.90, and that includes the Volapocalypse event, right? That includes that massive crash in there as well. So this product is actually quite successful. I mean, if you were to have a system where you could have successfully navigated away from this, you've got something that, even on a buy and hold basis, it would have done pretty well. So this is why I want this product to be relaunched, because there's many ways to implement one of those into our portfolio. It's much safer. We'll quickly breeze through the XIV. It's our old favorite product here. You can see just the disastrous crash during the Volapocalypse event. This thing launched at $10, November 29th, 2010, and it finally got delisted at $5.88. So buy and hold basis, XIV was negative through its life cycle. But of course, one of the things that my work is based on is using volatility metrics to try to navigate these products so that maybe you're not profiting every time it just rockets higher, but you're cutting off these losses. You're exiting quickly, moving to safety, remaining in cash during most of these drawdowns. And just a side note, my strategies exited in January of 2018, anywhere from 1 week to 2 weeks before the Volapocalypse event happened. So my strategies didn't lose any money here. We were able to capitalize on all the profits going upwards and didn't suffer this massive catastrophic crash. So that's what I would suggest for people to do with their volatility trading, is to look for ways to reduce the drawdowns. I mean, everybody out there, so many people on Twitter talking about finding ways to make the most money. Let's get aggressive. Let's use the TVIX, 2 times leverage. Let's sell naked calls. Let's sell naked straddles. Everybody out there is looking, seemingly, I wouldn't say everybody, but in general, it's certainly on Twitter, social media, that seems to be the focus. People are trying to outdo themselves by seeing how much they can possibly maximize the risk. That's not the way to trade these products. These can be traded responsibly. You can make a realistic, smooth, slow rate of return using these products. Anytime you're trying to get in there to just try to maximize everything and supercharge it and get the leverage and start using undefined trades in the options world, you're going to find you could really bleed a lot of capital very quickly, because nobody's signals are perfect. So if you err on the side of caution and you try to exit as soon as you possibly can, whenever there's the first sign of trouble, you're getting out of those trades, you might still be a day or two late. But a day or two late for a person who's safe is much better than a week late for people who are, programming the maximum possible risk. 1 week late on these products could be the end of your account. So, and certainly if you're trading undefined risk, this is the whole picking up pennies in front of the steamroller concept, where a lot of these people make super easy wins for a year or two straight. You can have 100 wins in a row selling these undefined risk trades, and then all of a sudden the market does something unexpected. You pay all of those profits back in one day, and you're blown up and owe the bank money. So please don't do that. Everything you do, number one, try to do safe first. Try to find a way to make a 10% rate of return using volatility products. Annualized, 10% a year. If you can do that safely and avoid the drawdowns, then you can start looking for ways to try to amplify that a little bit. And that's what's going to keep you in this market for 30 years, not 2, right? Remember, I don't know how old everybody is here, but I'm 45. I'm not trying to make a great rate of return this year. I'm trying to make a great rate of return that carries me through when I'm 70 years old. I'm still there, still with my capital intact, still making a consistent return. That's obviously the best way to trade. If you're out there trying to say, I'm going to knock it out of the park in 2021, I think that's the wrong mindset. But let's carry on here. Let's go to the last one on our volatility landscape. So this will be number 3 that I officially add to this list. It is the SVXY. Now, again, just like the UVXY, the SVXY also had a leverage change. So for the first, this thing launched October 3rd, 2011. For the first several years of this product, it was a 1 times inverse, just like the old XIV. It was essentially a mathematical mirror of the SVXY and the XIV. Because remember, both of these products are mathematically, the methodology is the same to the SPVIX STR index. This index, once again, this is the foundation for all of these products. So even something like SVXY and XIV, the old one, those are inverses, but it is still a one-day inverse methodology of this. So again, they are using only the front 2-month VIX futures. They are using a constant 30-day expiration VIX future contract, and then everything is based on this SPVIX STR index. So when we're talking, sorry about the scrolling here, when we're talking about the SVXY, which is an inverse product, it is just on a daily basis the inverse of that. So this one is the opposite of the steadily decaying insurance product that is VXX, UVXY, and the old TVIX. So for the SVXY, it deleveraged on February 27th, 2018, just after the Volatility spike. Apparently, the issuing bank wanted to take a little bit of risk off the table there because in live trading, this thing also crashed down an insane amount. Now, this chart you're looking at is calculated for 0.5 leverage all the way back. So just remember that the SVXY, it did also do this. It did reach a very high peak, and then it crashed over 90% in a single day. The reason you can't see it on a live chart, for any of you who are fairly new to the volatility space, the reason it doesn't look quite as diabolical is because this is showing the 0.5 times leverage factor. But make no mistake, this thing also crashed over 90% on that day. So they deleveraged to 0.5 times. So on a buy and hold basis, this thing again is up money on a 0.5 leverage factor. On a -1 times leverage factor, it would be down money just like the XIV was. Long term, for that 11-year period, it would be down money. But this one, buy and hold, actually 22% a year. So this is a product, let me go full screen here and wrap this up. This is the third product that we will add to our landscape. So we've got VXX, UVXY only for defined risk option trading, and then we've got the SVXY. And the reason this product is good is because it is an inverse volatility product. So you buy it on the long side if you think volatility is going to continue to be stable, right? This is exact opposite of VXX. And at 0.5 times leverage factor, there are a lot of people out there that are angry about this. They think that, we need the old XIV back. And I agree, we should have one. I'm hoping, and there is something on the horizon here. Let me go to screen share. This is my YouTube channel. I actually made a video. Sorry, I'll just use the search function. See if it comes up. A new XIV SVIX. You can watch this video. It's actually a year ago. These people are seemingly having some regulatory difficulties getting this thing launched. But we are hoping that there will be a -1 times product fairly soon, right? We've been saying soon for a long time. We're hoping that something actually comes around. But, sorry, I still think the SVXY is worth trading. As you can see, now it has turned into something that is very manageable risk. So you don't have to worry quite as much about those one-day shocks that will just wipe you out. Of course, as I said, my strategies exited well in advance, and we have not taken any major drawdowns in the last 10 years. However, that doesn't account for the fact that there could be something like a flash crash or, God forbid, some type of nuclear attack or something terrible. I mean, fill in the blanks. There's a lot of things that could happen that even signals like mine that have been picking up risk for 10 years well in advance, it is certainly possible that something comes along and just nobody gets it. Everybody's in it, and you just feel the full brunt of that hit. So keeping in mind that that is on the horizon as a possibility, I actually don't mind the SVXY as a product. So I will add that as well. I know you don't get quite the bang for your buck that you think you do, and it doesn't get a lot of eyeballs on Twitter, and nobody makes videos talking about the, half leverage factor SVXY. It's not sexy anymore, but don't discount it as a very viable volatility product to trade. One of the most difficult things in trading is managing risk. The most difficult. That's what it all is about. If you want to be here 30 years from now with a retirement fund that is intact, you need to consider yourself a risk manager, not a trader. Anybody who calls themselves a trader, there's trouble in that mindset. You want to call yourself a risk manager. And the SVXY gets you a little bit of the way there. It deleverages the product. It doesn't move quite as much. It's going to be easier to handle for most people. Now, if you are a super expert and you're fantastic at positioning your portfolio, your allocation sizing is spot on, at that point, you can start looking at the other products. But SVXY as a short vol product, definitely put it on your landscape. So those are the three. Like I said, in the past, I mean, we had a whole laundry list of these things. We had 20 or 30 of them going, and they've been slowly disappearing. Many of them had low volume. Some of them were crashed and burned in the vol-apocalypse. And some of them, like in the recent example of TVIX and ZIV, it did seem like Credit Suisse just wanted them off the books for some reason. And it wasn't specific to volatility ETPs. They had other leverage products on there as well, natural gas products. It wasn't that they wanted to shelf TVIX. I think they got rid of 9 of their ETFs in a single day. So we're losing some of these. And hopefully there are some on the horizon that will fill in some of those gaps that we used to enjoy. If I had my Santa wish list, ZIV, M4 to M7, a product like the ZIV, even if they went a little bit stronger, maybe, an M3 to an M5, something like that, if you don't exactly know what I'm talking about. When I'm saying M's, M1, M2 on the VIX futures term structure, I'm looking for a product somewhere in this middle range. I think that would be fantastic to, again, fill in that gap for people who really do like to manage their risk above all else. I think I'm losing my voice here. My last stream was 3.5 hours long. I didn't get crackly. Okay, so looking at the time, wow, sorry everyone. That was a 47-minute presentation. It was supposed to be 15 minutes. So let's get right into questions. Now, bear in mind, remember, like I said, for whatever reason, I'm using the eCam software. For whatever reason, I don't get to see all the comments. So you might see on the YouTube side of things, you might see the comment section going. We've got quite a few people in here. I maybe not see it all. So I'm just going to sort of glance at the stream and see what I can pick out. So Bosco Chan says, why do you like the ZIV more than the others? Well, it's like I said, I'm a risk manager. I'm not a trader. I'm not a gambler. I'm not a speculator. I'm a risk manager. And every strategy that I employ, everything that I do in my portfolio is, number one, considering the fact that I have a large community of investors who I have to make the assumption that they are like me, that they are investing significant portions of their net worth in all of my strategies. I have 100% of my net worth in my strategies. So risk management is absolutely paramount for me. And so when I can get volatility products that are playing in this reasonably slower moving range on the VIX futures term structure, then I can then look for opportunities to multiply my profits much quicker. So if you are using TVIX, for example, UVXY, you have to go many layers of risk management before you even consider trying to speculate and make some money, because that thing can wipe your account out faster than you can possibly know. It's happened before. Many of these people who promote it online, they themselves have blown up multiple times, and they're circling back to that same old thing because it does get eyeballs on Twitter. It does get followers. But remember, a lot of those people that talk about risk and let's chase big money, a lot of them have blown up multiple times. They're on their 4th attempt at this. So that is why I like the ZIV, because I'm a risk manager, not a speculator. And the ZIV just moves at the perfect speed. It is short vol. You can take advantage of those periods where the market is cooperative, but it's not going to bite your head off if you get things wrong. And we all get things wrong. I get things wrong all the time. I have losing trades all the time. The last thing I want is to have too much risk on the table and just get my head ripped off by a flash crash or a surprise Fed announcement or some type of legal action in an election, or, I mean, take your pick, any number of things. So ZIV is the best product there was. It was a real shame to see it go. Go to the more recent ones. This is a tough name to say. Iman? A-I-M-A-N? Iman? What is your preferred product for a shorter term outright long vol hedge? UVXY. That's a much larger question, and I could make a really long video on that. But I don't hedge my portfolio. So all my strategies are designed to interact with one another on a allocation sizing basis, and then each individual strategy has several layers of mechanisms that allow them to move to safety whenever the markets demand it. So instead of hedging my portfolio, which is expensive, remember hedging, like I said, the VXX is not a speculative tool, it is an insurance product. When you buy insurance, you are paying that money and it's costing you portfolio. Now, for people who are on the buy and hold side, or they're not nimble enough to exit out of positions on a one-day notice like I can, they definitely have to hedge their portfolio because bad things can happen. So if that was the case, the benefit to UVXY is that it has really good convexity. It can go up very, very quickly, and for a very small capital outlay, you could hedge a long portfolio. The problem, of course, is that it bleeds capital very quickly. So it's a calculation that you're going to have to make. What I would suggest to you, and this is going to take a lot of work, but get out a spreadsheet, calculate the individual beta factor of your portfolios and all the positions you hold compared to the S&P 500, right? So you are basically using the slope function in your Excel spreadsheet. You're going to calculate the beta factor of your portfolio to the S&P 500 and see how fast it moves based on market movements. And then based on that number, you can calculate the beta factor of the UVXY and the VXX, and you can buy the mathematical right number of shares to match your portfolio. And then you can decide how much of a loss you are willing to take, and that's how many shares you're going to buy. It sounds complicated, and it really is. Hedging a portfolio is deep science. It takes a lot of math and really, really good calculations. So on the one hand, I don't need to hedge, and I don't want to hedge, but nice little side note is that I don't have to go through all those math. So yes, you could use UVXY as a portfolio hedge. It would be a very small position, but yeah, you could do that. Make sure you calculate it though. Don't guess, because UVXY bleeds a lot. And if you get that calibration wrong, you could be in a little bit of trouble there. Some of these questions are long, so I have to read through them all. Bryce and Days says, do you have a beta neutral portfolio, and how many open positions do you usually have open over a 1 to 2 month period? So beta changes, of course, based on the positions that I'm holding. So let me open my model portfolio. Remember, this is our portfolio that we are, look at that. I forgot to do screen share again for the 5th time today. This is my test account here for the live streams. And essentially what this is, I am just trading what I call in my portfolio, the leveraged total portfolio. So this is comprised of 5 positions, 5 different strategies working together, right? They're completely independent. What I do in one has nothing to do with the other, but I have 5 strategies, and depending on what positions they are in, that would, of course, dramatically change the beta factor of my portfolio. So I've got, in this one, for example, we've got stocks, MVV, we've got bonds, UST, and we've got gold. Right now, we are in the MVV, right? That's that position right here. We've got an MVV position. And so currently, my portfolio, because I am fully long the market, I am leveraged in some cases. I'm long the Qs, the NASDAQ, and then we're in bonds here. So right now, I am a little bit more leveraged than usual. So obviously, my beta factor right now is a little bit different. But that will always change. And then the number of positions I hold will also change. So you said, how many positions do I hold at any one time? Each strategy can only hold 1 position. So the first 4 ETF strategies can only be holding one thing at one time. So that's 4. And then the VTS options portfolio can hold probably as many as 4 itself. So maximum 8, but you can see my portfolio is quite simple. This is the leverage total portfolio in its entirety. This is all it is, right? So it's just these positions working together. Of course, I've calculated behind the scenes of how these all interact with each other to come up with the right allocations. But I don't have a very complicated portfolio. And again, like I said, I don't require hedging because all of those strategies move to safety as soon as there's any trouble. Does sometimes mean you get whipsawed, but that is a whole lot better than getting your face ripped off in something unexpected. So Roberto Moroni says, do you think long put spreads on VXX continue to be profitable? High IV offsets most of the profits. Which days to expiration and strikes do you generally like for spreads? Thank you for your time. So the first question, yes, I have no reason to believe that the VXX put options are any less efficient these days. Of course, markets go through cycles, right? There are times when it works out really, really well, and there are times that it won't. The last 3 years for that specific strategy, the tactical volatility strategy that I have, it's been the worst 3-year performance. If you tracked the rolling 3-year numbers, that's been the worst performance of the last 3 years, right? At any period throughout when I started this business, 9 years ago now, that's the worst it's been. But that doesn't mean that it's broken. I mean, you have to look at the market for what it is. It's a constantly changing, organism that you can't just chase after the fact, right? I can't say, well, it's not working now, so let's just switch it up. There's no mathematical reason why it's not working. It's a period where the last 3 years since the Volpocalypse event, the trend following short vol strategies have not done very well, right? That's true across the board. Trend following has not done well. So anybody who has supplemented their portfolio with some options trading has probably done a lot better. It's just trend following short vol has been a real tough trade the last 3 years. And that's what that strategy does. So I have no reason to believe the VXX puts won't continue to perform just like they are designed to do. Not all strategies perform well all the time. You can't switch things up. The second part of that question was high IV offsets most of the profit. You have to remember that implied volatility and volatility itself is a relative term. Certainly you could make a case that volatility is high right now. I did an article recently, a video on the YouTube channel. Where are my videos? Talking about the average VIX. You might want to watch this video. The average VIX, while the average mean VIX is about 19, the truth is the average VIX, it does try to find a bottom near about 12 or 13. So you could certainly make a case that volatility is high right now. And if you're buying put options, you're paying a lot of vega to buy those put options. The thing is, it's a relative term. So if volatility hangs out in this range, which is very plausible, it could hang out in this, what we consider an elevated range, that could last a while. It could last years. I gave an example earlier in the stream of from 96 to 2000, the VIX was in the low to mid 20s, while the S&P is going up 30% a year. So this is not unprecedented to have volatility sort of get to the 20 VIX area, bounce between 15 and 30. That could last for years. And in that case, the relative IV of those put options, that's not considered high anymore, is it? Everything is relative. If the VIX goes back down to 10, sure, yeah, you definitely overpaid for all of your long options. But there's nothing saying that has to happen. So that is the second part of that. On a relative scale, volatility is fairly low right now relative to the last, 50 days, 252 days. It's still in a relatively low range right now. How many days to expiration? I'll just finish off this question. I do about 100 to 130 days out. That's the ideal opening period. And then if the strategy remains allocated for several weeks in a row, I will rebalance about 75 to 80 days to expiration and then try to fire it off again to over 100 days because anytime you're holding long options, you are battling against the theta decay, right? You're paying for that. Now, there's many ways, there's many benefits to holding long put options to short vol, right? People look at that and they say, oh, you're wasting money on the theta. Well, you are, but it's also a much safer trade. And the risk management is built into the long put option. You can only lose what you put up for it. and you can custom design your delta factor. There's a lot of benefits to buying long put options in the VXX to short vol. A downside is the theta. So if it gets to 75 or 80 days, I'm going to fire it out to about 100 to 130 days and start the cycle again. More questions. What's the time? It's exactly 1 hour. And I did say at the top of the stream, I'm going to try to hold these to 1 hour, but I feel like I went so long on the presentation and I messed it up. I didn't put the screen share, so that was a disaster. I'm going to go a little while longer. I'm just going to scroll a few of these. A small percent of portfolio long out of the money calls. On the VIX. So again, from Bryce and Days, these names, I'm going to get them wrong. What about allocating a small percent of the portfolio on long out of the money calls far out of expiration for the VIX? So I've got another video on the YouTube channel talking specifically about why buying put options on the VIX every time it spikes. Like if it goes to 80 and you buy put options on the VIX, why that's a losing trade. And it's not a losing trade if you do the same thing on volatility products. Answering this question is for a very similar reason. The VIX index is not the VXX. These are entirely unrelated products. The VIX index tracks the S&P 500 options market, and the VIX is not a tradable instrument. So that fact that the VIX is not a directly tradable instrument where you can't actually hold shares of it, it changes the market completely. So the options market on the VIX specifically is a totally different animal to all the other options markets out there. Because you got to remember that every time you buy an option, you are essentially, your counterparty is not some other guy. It's not some other person at Robinhood or whatever it is. It's the market maker who is doing that, and then they go out and they hedge that position by typically either using futures or by buying underlying stock or selling underlying stock, whatever the case may be. So with the VIX, things get a little bit weird because your counterparty is, not able to actually hold underlying shares. So it's a weird product. It doesn't be, plus it's a little bit mean reverting, it's mode reverting. So buying options on the VIX, whether it's calls, thinking it's going to go up as a portfolio hedge, or buying puts when it's already spiked and you're expecting it to go down, those just have a way of disappointing people. Those are trades that just don't ever seem to pay off. And the reason is because it is just a separate animal entirely. So I wouldn't disagree with that if you were the type of person that did hedge. Again, I don't hedge anything, but if you did hedge, do your option hedges on the volatility products, because those do have a counterparty that can actually hedge the underlying shares or the VIX futures or whatever that they need to do. So that's a long way of saying, unless you are extremely sophisticated in your understanding of options, I would just avoid VIX options entirely. It's a real strange little product there. It's great if you understand it. I've been trading VIX options for a long time. I've got my longest running strategy is what I call let me just move that. It's called my VIX option strategy. And I've been doing this consistently, basically just throwing out a net of VIX options for a very long time. And it's been very successful for me. This strategy's up, 51% annualized in the time that I've been trading it. A little bit higher drawdown here. It's ultra complicated. There's no way I could introduce it to the public. But if you understand the VIX, the benefit there is that you are a knowledgeable person in an ultra complicated product. And that does allow for some opportunities for arbitrage there. If you really know how it works, you can do that. But don't just jump into it. It is a totally separate animal to all of these other things. Maggie Keenan says, plus buying puts means you are fighting Vega decay. It does, again, but that is a relative term, right? Vega is something that if you're buying long volatility, you're paying extra anytime volatility is elevated. But elevated compared to what, right? Elevated compared to a VIX that for the next 5 years, maybe, we are going to see the volatility market, the regime change, and a VIX of 18 is going to be low for the next 5 years. An IV of whatever, 15, 18 is going to be very low. That might be the floor. We don't know. So it is a relative term. You really, really do need to take a holistic view of what volatility means in the market, because just the act of buying long vol doesn't mean you're overpaying for an option. You're only overpaying if you're overpaying, right? If there's plenty of times where buying volatility is cheap. So just keep that in mind. And certainly we currently have long, or we sold them on Friday, but we had long VXX put options open. One could make a case that we paid too much for those because volatility is elevated. But at the time we purchased them, volatility hasn't declined at all in that time. So again, it was not overpaying relative to what actually happened. Volatility is funny that way. And investing in general, it's all relative. Don't look at absolute numbers. Nominal values can be very deceiving. You really, really do want to hone in on the relative changes between these markets. Why don't you use inverse ETFs in your strategies like SDS when your strategies fire risk off? I can't say the name because it's a bunch of letters and numbers, but thank you for the question there. I can't even quite remember what it's called. I have a video there. If you want a more detailed answer on that question, email me, volatilitytradingstrategies@hotmail.com. I do have both a video and an article that explains that concept. Problem with doing live streams is if I'm fumbling around on spreadsheets, no, it's my other spreadsheet. Apologies, I can't pull it up. The basic reason is when we move to safety, say we are in bonds and gold or utilities or whatever that safety position is, if I substitute something like an inverse product, like say SH, for example, a 1 times inverse on the S&P, if I substitute that into the strategy, the performance is abysmal. And people are often surprised by that. Well, if volatility is super elevated and the market is risky and the chances of a sell-off is so big, why wouldn't going inverse the market work, right? That's a very valid question. The reason it doesn't work is because when the market bounces, it happens when those signals are flagged. So the market does this V-bottom bounce and it screams up higher, and you're still left holding a short S&P 500 or whatever the underlying is. You're still held short the stock market. Those V bottoms, as we've seen certainly in the last 3 or 4 years in this whole buy the dip market regime, they can just destroy your portfolio value. So I prefer, when I'm in safety, right? When it's time to move to safety, that's not a time to be saying, okay, well, let's immediately go into profit-making mode. Safety is safety, right? There's nothing safer than cash, so there's nothing wrong with just moving to cash. Instead of shorting the market when it's risky, just move to cash. That's the safest trade there is. I try to boost that a little bit. Again, reduce it to the base level of safety. You are a risk manager. Go to the very base level, cash. Then look for little opportunities where you can maybe add a little bit of profit. And that means holding treasuries, for example, when the market is full risk off. That traditionally has been a trade that can make some money. Maybe holding gold, maybe holding utilities. These things can actually make a little bit of money while still keeping to that risk off environment. You don't want to view risk off as an opportunity to lose more money. So the whole roundabout way of answering that is I always default to safety. And shorting the market when markets are the riskiest might sound a little counterintuitive, but that is actually the riskiest position you can take when the markets are risk off. Yeah, so there's a few questions of where I am. My sister chimed in there. He's in Vancouver. Yes, for the next, I'm going to say week at least, you will still see me here in Vancouver. And then I'll be packing up and moving out of here pretty soon. So I don't know where that will be. I have a little bit of business in Panama. So you may see that. Maybe in a couple weeks, you'll tune into a live stream and the view will completely change. I won't be wearing a sweater. I'll be wearing a t-shirt. I don't know. You'll just tune into the live stream. I might be at a different place. I travel a lot. And for anybody who does want to grab a quick coffee, you've been warned. You've got about a week or two. There's a coffee shop still open down the street. I've met some people there. It's pretty cool meeting up with people and having a chat. Remember, I'm not some online avatar that, doesn't really exist offline. I'm a real person. You can grab a coffee with me or something if you're in the area. You ever see me doing a live stream and you recognize the background? You think, oh, I'm right there. Yeah, give me a call. Give me an email. So let me just scroll real quick, see if there's any real good volatility-specific questions. Mark asks, seeing the VXX and VIX slowly ramping up the last couple of weeks, higher lows. Your current dashboards are short vol. What type of change in the term structure will flip your metrics? Well, the term structure isn't the end-all and be-all, first of all. It's a very good entry-level metric to start looking at. But let me just pull up my most recent email from last Friday, and you can see what I'm talking about. My volatility dashboard accounts for a lot of different metrics. So the volatility barometer is sort of everything combined. All of the things that I feel are important are combined into a single index, and this is what it looks like. So it is elevated right now, right? I don't like this range, and unfortunately we've been in this range for a while. This little sort of mid to high band between 55 and 70 for my strategies, that's sort of the most frustrating range that we could be in. I would either prefer it to just go full out above the red line, or let's just have a period where we can actually maintain a few trends. Of course, we can't choose the market. We just have to go with what we've got. But you're right, it is elevated and it is sort of bleeding higher lately. So my dashboard, though, is taking into account many different metrics, not just the term structure. So, of course, this one, adjusted M1, M2, this is term structure specific. A few of the other ones are term structure specific, and I track a whole bunch of things beyond just this. But what would I have to see to, I believe your question was, you sort of move to risk off? Well, I would have to see things go up a little bit more. So the band that we are looking at here, we are now at 63%-ish. If this gets any higher, then all of our strategies will be moving out. So this is the non-leveraged portfolio. You can see it's right on the line. It was just barely within less than 1% away. We just moved to cash here. We just ticked into bonds here, and we're still just maintaining our NASDAQ holding here. So, and then the leveraged portfolios are all mirrored. They're just leveraged. So it would not take much at all to kick the entire portfolio to safety. That could happen in one day. That could happen Tuesday morning. Just as a reminder, markets are closed Monday. So that could happen, and that's what I'm watching. I'm watching my dashboard. I'm watching the levels, and I'm well aware that we are right on the verge here. And as soon as it happens, the benefit to being a tactical investor that can be nimble enough to move to safety at a moment's notice is that I could go from full risk on Friday to a portfolio in safety on Tuesday. And typically you get, you take a loss when you make that switch, but I would rather lose 1% to 2% switching over to safety than hang on too long and lose 15 to 20% if the markets really get you. So you're right, it's elevated, it's moving a little bit higher, and we are dangerously close to going right back to full safety. David Lincoln, thank you so much for showing up. I mentioned David Lincoln a few times in my last stream, my last 3.5-hour marathon stream. Everybody needs to go on YouTube and follow this guy because he is far more of an expert in this stuff than I am. I don't know if I can still search you for VIX Crush. There you go. David Lincoln. Search out this YouTube channel. Either type in David Lincoln or just type VIX Crush. Or just follow him on Twitter. And he does live streams very regularly, right? I've only done 2. This guy's been doing it for a long time. Let me see if I can find. How do I search? Famous, I think it's at Famous Dave, isn't it? Sorry. Can you, David, can you just put your Twitter feed? But anyway, thank you so much for showing up. I feel humbled by the fact that there's somebody I've been watching volatility specific live streams for what seems like a couple of years, showing up in my feed. So thanks for the support for that. Yeah, I do speak highly of David Lincoln. He's former market maker, 30 years experience. Like I said in the last stream, you're never going to see this guy make those stupid videos where, watch me make $4,000 in 15 minutes and, subscription down below, buy my book. He doesn't do that stuff. He just teaches you what actually works, how to manage risk. So yeah, definitely follow the good people, ignore the Twitter trolls, the, only exist on Twitter type of traders. Stay away from those people. I can tell you, we wouldn't put up with that in any other walk of life, right? I mean, could you imagine, just imagine for a second, I'm going to go on a Twitter online guru rant because on the last stream I did one of these as well, but I might do one in every stream. Could you imagine if you needed to hire a lawyer and you were looking for a lawyer to defend you? It's an important case. Let's make it non-criminal. Let's make it something business related. You're looking for a lawyer and you find somebody on Twitter and they are talking like they're a lawyer. They're saying all the right things. They're using all the right lingo and everything checks out, right? They're a great lawyer. They're on Twitter. And then you just ask them a few prodding questions, right? Because this is important to you. And I hope your trading account is important to you. I hope that your developing retirement fund is something that's at the top of your list of things to protect. So you start asking some prodding questions. Where'd you go to school? I can't answer that. I didn't go to school for law. Oh, where did you pass the bar exam? Can you prove that you passed the bar exam? Nope, I can't prove that I even went to law school or passed the bar exam. Okay, well, I mean, do you have a website? Like, can I check out some of your other work? No, never posted anything ever. Trust me, I'm an awesome lawyer. I haven't got into all that scene. Can I read any articles you've ever done? Have you ever had anything published in a law journal? Nope, nobody's ever picked up any of my work. Nobody's ever done any of that. Do you have a track record? Can you tell me how many court cases you've won? How many times have you seen the inside of a court? Can't give you that information. Conflict of interest, that's private. Can't share any of that. Would you hire that lawyer? I mean, in no other walk of life would we even consider these people to hire them. But for some reason, when somebody posts something that sounds trading related on Twitter and they used a lingo that sounds familiar, they hashtagged VXX or UVXY, all of a sudden they're, in our eyes, apparently an expert. So there's a short little rant. And I assure you, David Lincoln's not one of them. So give his channel a follow as well. Would you consider debating Chris Cole? Daniel Lopez, thanks for the question. I'm fully familiar with Chris Cole's work, and I would say, a good half of it, I agree with, support. I think his underlying message is good. I just have a problem with how he structures his portfolios, and I think that holding a static long volatility position and a static gold position and static commodities positions, all you're really doing is bleeding capital for no reason at all. I mean, with just a little bit of homework, you can figure out methods and metrics that allow you to hold those asset classes at the most opportune times. So why would you? I mean, he's right in the sense that these portfolios that people have structured, say, stocks, bonds, the standard portfolios, they're facing significant headwinds going forward. He's absolutely right about that. Stocks are at all-time highs. Interest rates are, on the floor. The standard portfolios that these asset managers are promoting these days are in a lot of trouble going forward. So he's nailed that perfectly. And he's even picked a good asset class to do it with. The issue is a lot of it is buy and hold. It's not tactical. You're not moving in and out. So essentially, there's just massive portfolio drain and the performance suffers significantly. So would I ever consider debating him? I think the word debate implies that it would be slightly adversarial. I wouldn't want to do that. I respect his work. I disagree with his work, but I respect his work. I would rather have a conversation. And if a guy at that level, at that status, way beyond me, I mean, a following that dwarfs me, I mean, obviously he wouldn't even be interested in someone like me, at least not yet. I'm young in my career. Maybe someday Chris Cole says, hey, would I debate that guy? But I'd like to have a conversation with him. I'd like to understand why he's chosen not to. I mean, it seems like he's got his foot in the door with something that resonates as true and then didn't go the extra mile to really hash it out completely. It's sort of like a half-cooked product that he's doing. And I would just like to ask him, why not just go the full thing? Why not go all the way through and see it through and run the numbers and actually become a little bit more tactical? That would be good to see. But I mean, in general, good person to follow. I would recommend following him. You're going to get that offsetting opinion that is sort of, I wouldn't say it's anti-financial industry, but it's certainly anti-status quo. So, yeah, good guy to follow. I don't agree with everything he says, though. I do think my portfolio has far more advantages than his does. Just the fact that we can move out quickly. We're much more tactical. We don't bleed capital on the hedges and holding things that are bleeding for years. No need to do that. Economics at Simon Fraser University in Canada. So Jay Knutson, I don't get to see all the questions, unfortunately, but is that referring that you did that as well? Or are you telling the stream that that's what I did? Because I studied economics at Simon Fraser here in Vancouver and math. So I did a major minor in economics math. But if you're commenting that you did too, wow, congratulations. We both have a somewhat meaningless degree. Economics. I don't regret it. It's interesting. It's just that, of course, if you follow my work, you understand that I am a very, very data-driven person, right? If you don't trade the market as it is, if you try to trade the market as it is in an ideal situation, or as they would say in economics, on perfect competition assumptions, then you're going to lose all your money, right? You have to trade the market as it is. So I have a degree in economics from Simon Fraser in a discipline that is essentially perfect world type scenarios. And very rarely those perfect world scenarios actually collide with what we see in the economy. So I have a somewhat useless degree, but it was interesting to me. And if you have one as well, we have that in common, and I'm sorry that you did that with me. Yeah, thanks, Dara. Someone else asked that and Jay answered. So yes, I have economics and math degrees from university not too far away from here. That's too specific a question. If you guys have like ultra specific questions or complicated things, you can always email me. The website down below, the .com, just add at gmail.com or at hotmail.com, and that's my email. So in the rundown in the beginning of this stream, I did mention that I wanted to cut it at an hour. And as some of you who follow my work know, I have a problem managing time in the sense that I'm very generous with my time, or overly so sometimes. So what I thought I would try to do, and I'm going to stick to this, I want more streams that are shorter. So I don't know what the ideal time is, because I think if memory serves, I took up a half an hour. Oh, no, I took up 45 minutes just going over the vol ETPs. So I should do a good 45 minutes of questions as well. So maybe an hour and a half is the ideal time. I don't know. I'll work these things out. I'm going to scroll through and see if I miss some sort of way up the list. What software do you use to program the algorithm and perform backtesting? I have no programming ability at all. I don't use any programming softwares. Everything I do is in Excel, and I'm not particularly good at Excel either. I'm not an expert. I know how to use it. I've been using it for 15 years, so it works for me. But anytime I do need to backtest, it will be in Excel. I have the data. I've got massive amounts of data, and I can just perform any backtest I want. But to be honest, I stopped backtesting in a serious level probably about 9 or 10 years ago. I certainly did a ton of backtesting when I was building the strategies, but everything I do is live trading, and it's been live for so many years that at this point there isn't a whole lot of backtesting being done. It's mostly optimizing and tweaking the metrics and gathering more data. But I don't do a whole lot of backtesting anymore, but I used to just, back then I was drinking those Frappuccinos from Starbucks. I used to go to 3 different Starbucks and 3-hour sessions, each of them, get a Frappuccino, do 3 hours of backtesting, move to the next Starbucks, do another 3 hours. Those were the good old days. But yeah, I don't do a whole lot of that. And I'm not a programmer, so I'm pretty old school. I'm sort of that age where I did most of my early studies before social media, before programming really took over. So I am a little bit old school in that respect. Young enough to care and understand about learning, but just at that age cutoff where I wasn't in school with a laptop, right? I back in school, we still used pencils and paper. Can I discuss my opinions on Tony Cooper's work if you have a familiarity to it? I can. I mean, the famous paper that he wrote, I'm sure you're referencing that years ago. I don't even know the date. Good stuff. A good start, I would say. There's some meaningful things in there, but as with all things, markets change constantly. They evolve. Things that worked back then don't work now. What he was talking about, a lot of those concepts, they just don't apply to today's market. So yeah, I'm very familiar with the work. I went in a completely different direction, and that was probably, I'd like to say 7 years ago. Back in sort of 2010 when I started trading volatility products, we were doing it differently back then. It was an unknown. There was no volume. There was nobody talking about it, nobody trading them. So we did it a little bit differently. And then when the market evolved and it became a more robust market, those old concepts just didn't carry over very well. So I would say that you can study that work, and you can learn a lot from it. There's definitely some historical things in there that you want to know, but I don't think there's a whole lot of new stuff that applies. Ron Sullivan says the aggressive vol strategy is in the SVXY more time than the tactical vol, which is more impactful in creating the additional return, the extra time in, or the 2 times allocation. The time in the strategy is what's creating most of the excess alpha over the tactical vol. That is also what's creating the additional drawdowns. So tactical volatility is active. Last time I ran the numbers, I think 41.5% of the time, and aggressive vol is about 68.5% of the time. So you're talking about that extra band where you can hang into the trades a little bit longer. And of course, if you've been following VTS in the last, say, year, you can certainly see the advantage of that, because the tactical volatility strategy, just because of that band that we're in the volatility range, it's been whipped around a lot recently. And you get into the trade, it seems to be doing pretty well. Volatility elevates a little bit. That strategy moves out. Of course, what's kicking it out is that the market has spiked. So you sell on a down day. You capitalize, you realize those gains, and then you're out into cash. If it happens to be just a 1 day or a 2 day turnaround, the aggressive vol would have stayed in and it would just, balance out and wouldn't have lost any money. It can continue on with the trend. Tactical vol gets kicked out sometimes, and it can be very frustrating. So anybody who's followed my work recently probably thinks that strategy sucks. And quite frankly, it has recently. But it's certainly designed very well for certain market environments. It's just we happen to be in one that's the worst environment you could choose for that strategy. So to answer the question, the additional gains are coming because it can simply stay in longer. But hopefully you can see the problem with that of course, if that is the first one-day drawdown of what's going to be a large crash, tactical vol would have avoided pretty much the whole thing. It gets out on day one anytime there's trouble. So aggressive vol hangs out there. And like I said earlier on, sometimes just hanging in there 2 or 3 extra days can be costly. We're talking about volatility products that can move a lot. So both strategies are great. Well, talking about my own strategies, so take with a grain of salt. But I like them both equally for different reasons, and I trade them both equally. Same allocation size for both of them. I like them both. And I used to trade the old conservative vol that used the ZIV in an equal allocation as well. So I had actually 1/3 in all 3 of them. None of them are broken. It's just that some of them suck sometimes because of the volatility regime that you're in. You can't have any strategy that kills it in every market. And right now, tactical vol is just hitting a wall. Every time that spike happens, it just seems uncanny every time it just hits. But that won't be the case forever. But that's what's happening. SVXY, that strategy stays in longer, and it has been much smoother and far more profitable. It was up 50% last year, whereas the other one was barely up 5%. So, but then there are other years where tactical vol is up over 100% in the year. So there's that too. We just have to be steady. I've got a portfolio of many, many different strategies, and not all of them are going to work, but hopefully you have enough at each time that, if 7 of them are working well and 3 of them aren't, then you're still ahead. Out of so Vittorio is asking, is that the same Vittorio? Yeah, that is. Manente, or I don't know how to say your name. Apologies. I think it's an Italian name. Out of curiosity, how do you come up with the idea of rotating assets based on volatility matrices? I think that dates back a long time. So when I started trading, right, most people, when they start their trading journey, they trade stocks, especially back then. Like I started in 2005-ish, retired from professional golf, started trading. I didn't trade stocks back then. I mean, I did. I held stocks and, little holdings here and there, but I started my career as a derivatives trader. So for me, analyzing volatility was just what I did. So the natural progression, I was options trading from 2005 to 2010. And then when VXX came around, I was immediately going into that, and I traded that. And then it just seemed like a natural progression. Right around 2009, I launched a website that was called VIXtrader.com. I think it was in February 2009 or something. And on that website is when some people still follow me from that old stuff, by the way. It's really cool to see people follow me for 13 years. They're still in the community. But that website was when I really started to take my volatility metrics and start applying them to other asset classes like stocks and treasuries and gold. And so there was about a 2.5-year period there where I didn't have the business. It wasn't, VTS didn't launch till 2012. So from 2009 to 12, I was sharing publicly that whole process of taking my derivatives background and putting it towards all of the other asset classes. And I showed all the results, and that's essentially how my subscription model launched itself, right? It wasn't a plan. It naturally progressed. But so about 2009 to 2012 is when I made the switch to derivatives trading on derivatives to volatility metrics on standard traditional asset classes. And obviously, everybody has their own measure of what's successful and what isn't. And it's odd talking about your own strategies. It sounds like it's bragging, it's arrogant, but I think it's working out pretty well. I've done real well the last 10 years using those metrics and applying them to other assets. Because when you think about it, I mean, volatility is a metric that is measuring those assets, stock indices, stocks, right? Bond volatility is measuring bond. Why wouldn't you use those metrics? Why would I care about a MACD or a moving average crossover? That's just a price metric. I mean, why wouldn't you want to pop the hood and actually figure out what's going on underneath, right? It just makes perfect sense to me. But it's amazing how few people do that. I mean, my work seems unique. I've been posting it for 13 years now. At some point, you'd think that more people would be applying the same principles. I've not been secretive about it. Like I said, I've had websites talking about this stuff going all the way back to 2009. I would have thought there would be more copycats by now. We've been going for an hour and 29 minutes. Does that make sense? Hour and 35 minutes. So what do you think? Again, this is a work in progress, everyone. So I will be asking questions like this in the comment section. Just let me know, was today a decent format, right? I started the day talking about the volatility ETPs. I do apologize that I had the picture in picture wrong and you weren't actually seeing the charts that I was talking about. But if I adopt this format, is that going to work for everybody? The reason I'm doing live streams is so I can communicate more information in a shorter period of time. Making my videos is very time consuming, and if I could do live streams once or twice a week, it would really allow me to educate far quicker. So, hour and a half, good. I can go for a run. It's not sunny out, but it's a beautiful day. Thank you, everybody, for the questions. If you asked something and it looked like I avoided you, again, I may have, I may not have. I will have to watch the rebroadcast. Some of the comments don't show up. But if you have something that's really quite detailed and I missed it and you really have a burning desire to get an answer from me, then go ahead and email me and I will try to give you a better answer than 5 minutes on a stream. So thanks, everybody. I will think about a topic and maybe come back mid next week and present something else interesting, volatility specific. So thanks, guys. I'm going to shut it down now. Have a great day.